Hello and welcome back to our channel Polo Vega. Before we get on with our presentation, I would like to grab your attention to the disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the fourth of a series of interactive videos aimed at giving an insight into the concept of risk versus return. Risk versus return. As discussed in our earlier videos, saving is the first step in wealth creation, and investing or making the saving work its way up is the second step. What the investment brings us back is the return that we receive on our capital invested. However, there are two very important conditions that must be met before we invest our capital to expect an estimated amount of return. First and foremost, the return must be higher than the prevailing rate of inflation in the economy. Otherwise, you end up diminishing the value of capital invested. Secondly, nothing comes for free, and so does return on investment too. The price that one needs to pay for earning a return on investment comes in the form of uncertainty, known as risk in economics and finance, and is measured in terms of standard deviation or sigma in statistics. Risk. Uncertainty of returns is the biggest challenge faced by an investor with regards to returns on investment. The higher the expectation, the more uncertain is the expected return. When we talk about uncertainty, we are talking about the chances or probability of losing a part of the capital or the entire capital as compared to the chances or probability of making a profit or appreciation in the value of the capital invested. If one takes the weighted average of all the probable values of return, then the mean value represents the expected return from the investment, while the deviation from the mean is a risk that one needs to undertake while getting into the investment. The normal distribution curve in the picture on the next slide shows the distribution of possible outcomes in terms of standard deviation. Normal distribution curve, or the bell curve. The curve shows that 68.2% of outcomes will lie within plus or minus 1 standard deviation of mean value, 95.4% outcomes lie within plus or minus 2 standard deviations of mean value, and 99.7% of outcomes lie within plus or minus 3 standard deviations of the mean value. The picture on the next slide shows the location of various expected returns which are within plus or minus 1 standard deviation, 2 standard deviation, or 3 standard deviations from the mean value. Bollinger Bands and other tools to measure risk. The GBP/USD candle chart on the preceding slide shows us the location of the price of the forex pair on a daily chart, with the left hand chart showing the Bollinger Bands 1 sigma or standard deviation away from the mean, the right hand chart showing Bollinger Bands 2 sigma or standard deviations away from the mean, and the lower chart showing Bollinger Bands 3 sigma or standard deviations away from the mean. On the lower chart, we can barely see any candle breaching the band. In other words, if you can stomach 3 sigma or standard deviations from the mean, you can safely ride out or trade on the pair to book 3 sigma returns on your investment. Similar to Bollinger Bands, there are many other tools like oscillators, RSI, MACD, stochastics, etc., which guide us on the momentum and range of price action of different assets over a certain period of time. Since we're still at the early stages of learning the relationship between risk and return, we shall come to see these tools a second time around when we start talking about high risk assets and ways about getting aboard these asset classes. At this point in time, we just want to learn if we are risk averse or have an appetite for risk. Risk-free assets. When we talk about risk-free assets, we are speaking about absolute certainty of return or zero risk. There's nothing in this world which we can call as totally risk-free. However, the closest choice in the category of risk-free assets are treasury bills, government bonds, or fixed deposits with banks in developing countries. One can contradict the above statement on the basis of the turbulence or volatility seen in the bond market during the recent past, and this has not only affected the common man but also major institutions and hedge funds trading in the fixed income or the bond market. Since the discussion is beyond the scope of the current topic, where we are just trying to introduce our viewers to the concept of risk versus return, we shall touch upon the topic of bonds, interest rates, yield and yield curves, and the cause of volatility in the bond market at a later stage. As of now, we shall just satisfy ourselves with the statement that long-term government bonds from developed economies and fixed deposits from developing economies are assets that are closest to the definition of risk-free return, as the investor feels that the government or the central bank can never default on their payment, hence the investment is 100% safe. Risky assets. The low to medium to high risk assets consist of gold, silver, platinum, precious metals, metals used in production processes, grains, commodities, real estate, currency pairs, stocks, futures, options, etc. Depending on their appetite for risk, investors take long, short, or medium-term positions in any of these asset classes or a group of these asset classes. When an investor takes a position in more than one of these asset classes, then the total risk gets diversified and reduced as compared to the risk on the individual asset. This is one of the reasons why most investors prefer to invest in a portfolio of assets rather than investing in a single asset or asset class. We shall again revisit the subject of diversification, hedging, and other strategies to reduce risk or take a safer position in times of higher volatility. Therefore, we conclude that there is always a trade-off between risk and return when you decide to take a position in any kind of asset. The premium for getting the return from an investment comes in the form of risk or uncertainty that one has to bear with while waiting for receiving the desired return. The higher the expected return, the higher is the risk or uncertainty attached with it. And the lower the expected return, the lower is the risk or uncertainty that comes with the investment. We sincerely hope you enjoyed our short video presentation which tries to highlight the relationship between risk and return. In our next presentation, we talk about rate of return and the components that go into determining the rate of return from an investment. If you liked our video, please give us a thumbs up and subscribe to our channel by pressing the button underneath. Speak to you again on our next video. Till then, keep saving, keep investing, and keep getting wealthy. You may also visit us at www.polovega.com or connect with us on our Twitter handle @polo_vega.